It's a late summer afternoon at the Bank of England, and deep in the basement corridors, the young economic modelers are hard at work. With furrowed brows and reams of data, they're taming complex equations, harnessing the most advanced econometric techniques. It's a solemn ritual, quantifying the future rate of consumer price growth so that the monetary sorcerers upstairs can set interest rates accordingly. Much like young Harry Potter learning the ways of the wizarding world, these apprentice model builders are being initiated into an ancient tradition, one that confers its practitioners with great power but also great responsibility. For in their hands rests the economic fate of the nation itself. Miscalculating inflation could bring on ruinous price spirals or devastating recessions. As the hours pass, the work goes on, line after line of code wrestled into submission. Finally, after nights of toil, the new silver bullet inflation forecast emerges, laser-printed and hot off the presses. Upstairs, the gray eminences, the monetary policymakers themselves, await with bated breath. The young modeler arrives, clutching the sacred parchment, ready to unveil the keys to economic wisdom. But then, something odd happens. The wizened central bank governor takes out a pencil. And with a few casual flicks of the wrist, he scribbles out his own prognostications on a blank sheet, disregarding all the arduous modeling below. As it has been for ages, the pencil has trumped the computer core. This is the contradictory reality at the heart of modern monetary policymaking. We have constructed an elaborate econometric cathedral around inflation forecasting, an intricate neo-Gothic framework of models and projections. But at the center sits merely an empty stone dais, and on it, a curmudgeonly old wizard scrawling away with pencil and paper. Not so long ago, central bankers hailed the dawn of a scientific revolution in policymaking. By peering ahead into the economic future, they could make data-driven decisions, preempting inflationary pressures before they emerged. No more flying blind, reacting to already ingrained price movements. They'd become grand seers, inflation's Delphic oracles. It seemed an innovation of historic proportions. Economists constructed mighty general equilibrium computer models to forecast inflation, employing the most rigorous mathematics and latest theories. Policymakers solemnly vowed to exercise constrained discretion, enshrining these model projections as their new monetary policy lodestar. The economics profession became awestruck cheerleaders. I too drank deeply of the Kool-Aid, celebrating this new policy-making framework as breakthrough technology that would anchor inflation for good. But something got lost in the overcomplicated temple worship. While mastering the theory, we forgot the practice. As former Fed Chair Ben Bernanke wisely diagnoses in his recent forecasting review, the whole process has become unmoored from reality. Models that can't capture systemic financial busts or pandemic supply shocks. Fan chart probability ranges so wide they're meaningless. Modelers themselves reverse engineering projections to rationalize pre-cooked policy paths. We thought we were erecting a celestial economic observatory to peer into the future. Instead, it's become a divergent series of computer games, crystal balls, and tarot cards, each powered more by voodoo economics than hard science. The brutal truth is that even the most advanced models are perpetually behind the curve, chasing after events already unfolding. Like horses affixed with blinders, they lead policymakers into self-induced blind spots, missing tectonic shifts until it's too late. To be sure, inflation targeting itself has succeeded, helping slay the once rampant dragon of runaway prices. But that owes little to the forecasting rituals themselves. Those were always more exercises in storytelling than empirical discipline. By fronting the sham of scientific inflation projections, we've given the angry villagers something to latch onto while the wizards behind the curtain spin their spells freely. A bit of ceremonial numerology to nod at rationality, forecast fans kicked up as decorous cover. But never any true windows into their souls. Perhaps it's time for a reckoning, as Bernanke himself implies. Out with the complicated models and probabilistic fans, in with simpler scenario planning that embraces uncertainty. No more hocus-pocus over spuriously precise interest rate paths, better to be clear about the judgments at hand. Do we really want monetary mystics, ensconced in gated gardens, casting runes behind closed doors? Or a more open dialogue from those entrusted with shepherding the economy's meadows? We yearn for pristine scientific predictions of future inflation, untainted by all too human failings. But that's a childlike hope for a world where the foremost monetary decisions remain as they've always been: more art than science, more alchemy than astronomy. The path to enlightened policy needn't travel solely through forecasting, after all. Throughout the ancient traditions, wisdom flowed from other sources as well. Disciplined judgment and real-world observation. Transcendent perspective and humble counsel. A reverence for bitter experience and eternal verities. As we lose faith in the pseudo-certainties of our computational temples, other modes of illumination can emerge. A renewed appreciation for monetary's manifold uncertainties. An epistemic humility before deeper forces at play. More democratically open deliberation, stripped of numerological pretense. Perhaps then our entranced modern-day scribes will look up from their blinding monitors and pay true reverence to the mysteries they've been tasked to steward. For in the eternal tension between order and chaos, there lies an ageless wisdom the models cannot know.